Hey everyone, thanks for tuning in for the 10 market themes for the third quarter of 2024. As you know, a lot of the times these themes will extend, they're more long-term themes, but a lot of times they're relevant to what's going on and are the things that we're looking at in regards to portfolio management and design. So we always want to keep you guys up to date. So let's jump right into them. I'll try to make this as short and sweet as possible. I know I get a little long-winded sometimes, but here are the 10 themes, and the first one is asset classes. We'll spend quite a bit of time on this one. I've been getting quite a few questions, funny enough, from other financial advisors, and they're asking, how do you address this issue? So I'll walk through that in that first chart there. Then we'll go into some of the market drivers, themes, some of the equity factors, and a lot of this is all going to fall back on the Magnificent Seven. So you've probably heard that in the media, and that's going to be like Microsoft, Apple, Google, Facebook, Nvidia. There's a couple more of them, and those are what they're calling the Magnificent Seven versus the other 493 stocks in the S&P 500. So you'll see that theme throughout this, and then we'll turn into some economic information before we wrap it up. So on to the first chart here, and this is the asset classes, and this is mid-year performance. And so what I did is I went through and I just put together these big broad asset classes and show the return for the first half of the year and also just the second quarter. NASDAQ, as you can see, is up 17%, S&P's 15%, 4% in just the second quarter, 7% on emerging markets, international emerging markets. And then here's the equal weight S&P 500. So when you see the S&P 500 that's reported in the media, that is a market cap weighted index. So all that means is the bigger the company, the more weight it has in the index. In an equal weight S&P 500, it's all 500 companies are equally weighted to get the returns for that benchmark. Then we got some commodities, international developed markets. That's going to be like the UK, the European Union, Japan. High yield bonds, US small cap, and investment grade bonds. And as you can see, the primary movers for this year have been the S&P 500 and the NASDAQ. And that is because of the Magnificent Seven, large cap tech companies. And then you look at the rest of the returns, and you can see that the next best is half of, or a little bit less than half of what the S&P and NASDAQ have done, and that's the emerging markets. So when you diversify a portfolio, you're going to own a bunch of these other asset classes. There can be even more. These are really big, broad-based ones. But when they don't do as well as what people are benchmarking to, which is the S&P 500, then it looks like their performance is lower than the S&P 500, but it is because they're diversified. And the other asset classes haven't done as well during this time period, which again shows the magnitude of the correlation between them. So how I explain it, and this comes from a client of mine that plays poker. I don't know how to play poker, really. I know some basic rules, but as he described it, then I was like, that's a perfect analogy to what's going on right now. And so my example, if you're a poker player and know all the rules, then forgive me because I'm probably making up rules as I go, but just assuming that you're sitting down at a table and you can play 10 hands of poker at one time. So you've got your cards dealt to you, you turn them up, and so you're sitting there looking at them all, and you see this, one out of the 10 hands is a really good hand. And so you think, I'm going to bet more on this one hand. So instead of playing each hand equally, just lining up your chips across the 10 hands, you allocate more into this one hand. And let's say you win. And then each time you do that, it reinforces it. That's like the S&P 500 or the NASDAQ right now, to where people start feeling that FOMO, the fear of missing out, thinking, I want to allocate more, I'm more aggressive, I think I can, I know I can take on that risk, because people tend to look at the recent past and extrapolate that into the future. They think the future is going to be somewhat similar to what's already happened, and in most cases it's dramatically different. And in economics we'll call those shocks. You have a shock to the economy or a COVID shock. financial crisis, these things that are seemingly unpredictable, but a lot of times you can see it in the data. You'll start seeing data come in that looks a little off. So let's assume that, again, back to the poker hand, that you keep betting and you look at your hands and then you come across that hand again and it looks great. And so you continue to add to that hand. So you add more of the chips that you have over here, and instead of adding to the other 10 hands, you really focus on this one hand. Well, Bob, who's on my right, beat you on that hand. And so then it pulls a lot more of your chips because you bet heavily on that hand, as opposed to betting equally or not so much weight into this one hand. So then when the bad hand comes to you, or I guess the bad round of the table, the bad flip of the card, then it sucks more of your capital away. And that's what happens in markets. A lot of the times people chase performance. And so they look at the S&P and go, man, it's outperformed everything for the last few years. You know, I want to allocate more into it. And then when the markets do turn, then they realize how risky, you know, that was. Again, the best case is, especially when you're dealing with uncertainty, you don't know that commodities aren't going to do really well next year. You don't know that U.S. small caps are going to outperform large caps, when, as you can see in this graph here, that year to date they're up 2% versus 15%. But you don't know the next half of the year could be dramatically different, or next year. A lot of the times these are paradigm shifts. So how I used to explain this was I would just take decades of these same asset classes and then show them through the decades and show that there's, you know, 5 and 10 year windows where, for example, the S&P 500 and NASDAQ are way underperforming the rest of the international markets, emerging markets, and even other U.S. equity markets like small caps and mid caps and things like that. So you can see that it changes through time. So just because we're in this period right now, there's no way to know when it's going to change. You will notice it in hindsight. Just like with the S&P and NASDAQ, you can look back and go, they've outperformed all these other asset classes over the course of, you know, 1 year, 2 year, 3 year time period. So you extrapolate that into the future. That's going to continue. And in most cases, it does not continue, or if it does, it'll continue for a little while. But eventually the markets go through cycles, and in different economic environments, different asset classes do well in those environments. Just like 2022 and 2021, commodities did really well, outperformed equity markets during that time period. But if you were all in the S&P 500, you'd have missed that. If you were all in commodities, then you've missed this run in the S&P 500. So again, it's the same with the hand that you're dealt in poker. Whenever you look at it, it's all about probability. And there is an element, I guess you would say, in poker of luck. In the markets, it's more valuations and analysis. But that's what gives you your edge to know, should I allocate a little bit more into international? What would cause international to outperform U.S. markets? A lot of that, especially emerging markets, you can look at the dollar. Is the dollar strengthening or weakening? What are the factors that are causing the dollar to weaken or strengthen? And you can know from there that emerging markets do well when the dollar's weakening. They don't do so hot, but do okay when the dollar's strengthening. So that's how you would allocate and adjust a portfolio based on these kind of like cause-effect relationships. So I told you I was going to spend quite a bit of time on this chart because I feel that it's relevant, especially in the moment when all you're hearing in the media is, I always remind people that the same thing happened with the internet, you know, in the 90s. And that was, you know, a decade run. And the NASDAQ, it went up double digits every single year. It was in like the 20% a year for many years. And people were saying the internet's going to change the world. And did it? Absolutely. The internet changed the way we do things. The entire world has changed because of it. But was it justified at that time? And no, it took it a long time to filter through. We're now, 25 years since the tech bubble, but here we are in this AI. And is AI going to change the world? Probably. Is it going to happen next year or in the next 2 or 3 years? Probably not. So we'll get into an Nvidia chart here in just a minute. But again, I wanted to focus here so that people understand the risk of concentrating a portfolio in a specific asset class versus diversifying and managing your portfolio for risk as opposed to just trying to chase those returns. So Next, we're going to look at the earnings growth and valuation multiples. So this, you can't trade off of this. You can't make a short-term decision looking at price to earnings multiples because they can stay elevated for long periods of time. But you can see here on the left chart, it's trading at about 21 times next year's earnings. And so again, I've mentioned this before, but price to earnings is really the price of the individual security or market as a whole divided by its earnings. And what that tells you is if the price to earnings is 10 and that company or market earns $1, you're willing to pay $10 for that dollar of earnings. So if it's a multiple of 20, that's why they call it a multiple. You're paying either 10 times, 20 times a dollar of earnings. And they can stay elevated, and you're paying for the growth that you expect the companies to do well and to continue to grow earnings and revenues into the future. But right now they're trading at 21 times. You can see pre-COVID, is around anywhere from 16 to 18 times. I want to say the average over decades is around 16 or so. So we're definitely elevated at this point. But you can see on the right-hand side that the S&P's earnings are expected to grow by about 10% next year. So that could justify a higher multiple, but typically when you have elevated multiples, one of two things: either the price has to come down or earnings have to go up. And you don't know, based on this, either that forecast is going to be a little lower than what it is, which would not justify or would increase that multiple, but we'll definitely keep an eye on it. This is the other chart on Nvidia. And so this blew me away, just pulling in the data and noticing that its peak was still under a $1 trillion market cap. And that just means what's the entire company worth. Really, it's the stock price times the number of shares outstanding, which tells you what the entire company's worth, its market capitalization. So it was at about less than 1 trillion in 2021. And of course, 2022 came way down. But in January of 2023, it was at about $400 billion. That was the market cap. That's how much this company was worth at that time. And then in a short 18 months, it's more than tripled. It's went from $400 billion to $3 trillion in about an 18-month window, getting close to 2 years. So comparing that to other markets, when you look at Berkshire Hathaway, which is down here, definitely grew. And this is going back to 2014, so this is, a decade. It went from, let's call that 300 billion to about 900 billion, so almost a trillion. When you look at the market capitalization of the entire UK stock market, it really hasn't gone anywhere for a decade. And same for the Russell 2000, which are 2,000 stocks in the United States. And it's went from, I'll call it 1.7 trillion to 2.5 trillion, so definitely some growth there. But when you compare broad markets and even a great well-run company like Berkshire Hathaway compared to Nvidia, it puts things into perspective. That, it is crazy that a company can go from, half a trillion, I guess you would say, to 3 trillion in a year and a half. Now, does it mean it's going to just come cratering back down? No. If they continue to earn and continue to have pretty much a monopoly on the AI chips, they can continue to move on as long as there's demand for those chips, like there has been over the last couple of years. So I would say that once a Microsoft and a Google and an Amazon buy as many chips as they need to do what they're going to do, I don't think the growth will maintain its past year and a half, 2 years growth rate. But will it continue to grow? I think absolutely. But again, this just puts things into perspective. And looking at the S&P, and we talked about the market cap, weighting of the S&P versus its equal weight, this gives you a good barometer of how much a few companies are impacting the S&P 500 versus the other companies as a whole. So this is, again, looking at the S&P 500 market cap versus its equal weight. And right now, it is outperforming its equal weight counterpart by more than any other time since 2000. And the last time this high was actually higher in 1998. This is again leading up to the big blow off top of the tech bubble. So then you look over here on the right hand side, and what you'll notice is this is going back to 2000, so almost 25 years that there's only been 24% of the companies are outperforming the S&P 500 as a whole. So typically, as you would imagine, that over a long period of time, the law of large numbers, takes hold. So there should be roughly 50% of the companies outperforming, 50% of the companies underperforming that average. And you can see that average here on this orange line there, 49. So it's about half of its average, which is saying these other 493 other companies are not outperforming, or at least only 24% of the 500 companies are outperforming. So a very interesting metric there as well. So now we'll flip over to the economy. So we know where the S&P 500 is a market cap, weighted versus equal weighted, and then what the other asset classes have done. Right now we know that inflation is still on everybody's mind, and even though it's down to about 3% right now, a little bit higher than that, you'd have to say that on average the Fed's going to cut when it's below that 3. We're already pricing in 2 rate cuts. The markets have priced in September as the first rate cut, and I think they have it in close to that 25 basis point. But right now they're in that iffy territory where if they cut too soon, then they could see inflation bounce back, and it's a lagged indicator. So when the Fed starts cutting rates, inflation doesn't just pop back up. If it's going to go up, it'll take sometimes 18 months or 2 years before inflation starts ramping back up. So I would say that right now the Fed probably shouldn't, but that's not to say that there's not certain parts of the economy, like unemployment has ticked up almost 0.5%, and there's an economist out there that had the Sham rule or Sam rule that pretty much says that if unemployment ticks up by 0.5% from its lows, then we see a recession. And we're getting close to that, so maybe the Fed's eyeing that, the unemployment rate a little bit more than they are inflation, because their dual mandate, you have to keep in mind that their dual mandate is stable prices and full employment. Those are negatively correlated in some respect. So whenever you're in a period like this, where you have like a stagflation environment, still have elevated inflation, the economy's growing better than it was prior to COVID, but when you have that period where unemployment's really low and inflation's high, when you start bringing down inflation by raising rates, slowing the economy, you should see unemployment go up. So they're playing this tug of war between, do we really want unemployment to tick higher? Are we okay with inflation running a little hotter than expected? And I believe that's why, a few years ago, they started using averages as opposed to a 2% target. We want inflation to run at an average of 2%, which means it can run hotter for a period of time, especially if it's ran below trend for a period of time. So they may use that in the next meeting. We'll have a Fed meeting this week, which will be a key driver of markets. I believe it's Wednesday. Yeah, it's Wednesday at 1 o'clock. They'll announce what they're going to do with interest rates, and then, of course, he'll have his press conference where he's going to talk about what they talked about and answer a lot of questions from economists. Comparing that, where we think the U.S. is going, they're going to cut rates roughly around September. That's what the markets have priced in. I still say it's too early to tell. But if we look at central banks as a whole across the entire globe, then you'll see that we're getting a lot more cuts. We know Canada's already started cutting interest rates, the ECB, Switzerland. So net economic policy is loosening policy, whereas we're still maintaining a pretty tight monetary policy. And this is on everybody's minds as well. The affordability of homes, as we know, has gotten out of reach for a lot of people, especially first-time home buyers. When you think back to, a few years ago, you can get a 30-year mortgage for less than 3%. Now it's at around 6 to 7%, which is double that, double the interest payment. So for a lot of people that could buy a $500,000 house 5 years ago, now they're looking at, a house that's valued at a lot less just because the mortgage payment will be a lot higher. But another key driver here is people are sitting on their homes. They're not selling. So if you own a home and you have a 3% mortgage, you're not really jumping up and down to sell your home to double the interest rate. But since interest rates are higher, even the building permits and housing starts are at 4-year lows, and the trend looks like it is definitely down. Until they start cutting rates, I would expect that the housing is going to struggle. But some green shoots, some things that I noticed that I thought was interesting to share with you guys is, if you look at economic data, most of the time it's monthly and quarterly data. But there are data points that come out a lot quicker than that, like weekly, some are even daily. If you're looking at just S&P 500 as part of the LEI, the leading economic indicators. But this is a weekly economic index put together by the Federal Reserve, and it looks at like railroad traffic, retail sales, electricity usage to determine, which way the economy is headed. And the good news is here over the last several weeks, we've started to see an uptick in that economic activity. If that continues, we'll likely see that filter into GDP, which means GDP should be even better, economy should be doing even better. With that, we have to keep an eye on inflation because the Fed's trying to slow the economy down, and this looks like it's trying to pick up. We'll definitely keep an eye on that as well. The other component that I hear a lot about, you guys probably don't hear a whole lot about the high yield corporate market. These are companies in the high yield market that don't have the best balance sheets. Their credit rating is below like double B. So they're high yield bonds. That just means they're a lot riskier, and because their balance sheets aren't as strong, if they have to roll over their debt from the 0% rate environment we had for the last decade into a higher rate environment, a lot of those is going to put a strain on a lot of those companies' balance sheets. So right now what this data shows is current yield on high yield bonds is right around 6.3%. That's because those bonds were issued in a lower rate environment. So the top line right up here, the 8%, this is if they all rolled their debt over right now, they would have to increase what they paid in interest from 6.3 to about 8%. And that 2% move is similar to what you'd see in mortgage rates as well, to where it would definitely slow down. Some of these companies would definitely be bankrupt if their margins are so small anyway. But the good news is next year, there's only about 2% of the high yield market has to roll over a portion of their debt. But as you can see, as the years roll on, more and more of these high yield companies will have to roll over their debt. And if the rates stay high, then they're going to have to roll over and pay more on their debt, which again will squeeze margins. And a lot of times that's whenever you see a big spread develop between the high yield market and investment grade market or even treasuries. But as of right now, it's nothing to really worry about, especially for the next year, again, unless there's some type of shock. So this is the last chart. And again, this kind of goes into the Magnificent Seven versus everybody else, the remaining 493. And this is just based their earnings growth. So in 2022, you can see that the Magnificent Seven, even though their earnings growth was negative, it was not near as negative as the remaining 493. But then that flip-flopped in 2023, and this year is why you're seeing that outperformance, is because their earnings are expected to grow at, it's a double-digit growth rate versus the other 493 that are barely expected to grow. But if you look out into next year, the forecasts are for the other 493 to catch back up, at least on year-over-year growth in earnings per share. So that could provide some opportunities in that portion of the market, even in markets outside the S&P, such as small caps, mid caps, that have really been either beaten up or just haven't done near as well because their earnings haven't kept up pace with the Mag 7 or even a lot of the S&P 500 companies. I hope that brings you up to date on kind of what's going on in the markets and even in the economy. Gives you a good perspective on, what the Magnificent Seven, what's driving the S&P 500's return versus all the other equity markets. We know that it's really 7 companies are driving the majority of that return. And will that last? It could for a while, but will it last forever? Not likely. Anytime you've seen performance like that in order for it to continue, the demand, you just have to have companies popping up everywhere demanding the chips and the AI and all the tech stack that goes along with it. If you guys have any questions, feel free to reach out. And until next time, guys, choose your advisors wisely. Your financial health depends on it.